Hello class, this is Dr. Carl Etamendi, and the purpose of this video lecture is to help you all with a couple of the Excel assignments towards the end of chapter 3 for the Fundamentals of Corporate Finance book, 3rd edition. So in this video lecture, I'm going to be doing 11 problems in particular. These are the ones that are in the back of the book, and I'm going to show you how to actually come to those answers so that you can be able to benchmark off of those and hopefully answer the rest. So the questions that I'll be going over specifically are 3.1, 3.5, 3.7, 3.9, 3.13, 17, 19, 21, 23, 25, 27. Okay, so now let's start with question 3.1, and it reads, given the following information about Elk Ridge Sporting Goods, Inc., construct a balance sheet for June 30th, 2014. On that date, the firm had cash and marketable securities of 25,135, accounts receivable of 43,758, inventory of 167,112, net fixed assets of 325,422, and other assets of $13,125. It had accounts payables of 67,855, notes payable of 36,454, long-term debt of 223,125, and common stock of 150K. How much retained earnings did the firm have? So now in order to solve the problem, the first step that we're going to do is to identify the given. And it's really going to be like my main tip to you all whenever you're doing any one of these problems in finance is to always identify the given. Kind of like algebra, although it's not really so much algebra, although one of our questions is going to be kind of algebraic. So the given is basically everything that's in the problem that we know of, right? We know the cash and marketable securities, accounts receivable, inventory, net fixed assets, other assets, account payable, notes payable, long-term debt, and common stock. So the point is that we need to find out how much retained earnings the firm had, right? So now the next step that we're going to do is to go ahead and put together the balance sheet, right, for the period ending June 30th, 2014. So we have to start identifying first the assets, the total assets, and of course this is the answer here, but perhaps I could, well, we'll get to that in a sec. You have cash and marketable securities, 25,000. The accounts receivable of 43, right? That's given from up here. So then we can kind of cross those out in a way once we're done with them. An inventory of 166,000, right? So then to identify the current assets, all you really do is just add them, right? So in order to do that in Excel, you can do a couple things. You can either do equals, click that, plus click, and then press enter, and you get that answer. Or you can do equals, sum, open parentheses, you highlight your range, close parentheses, and then press enter. Or my favorite is you highlight the range, right, and the empty column, the empty cell where you want your answer, and you click on auto sum, and you get your answer. If you're using the Word version, the Office version is going to look a little different, but you'll still see the same sigma, okay, the sigma sign. So now we have current assets. Next, we need we need to identify the total assets, right? So the total assets is going to be the net fixed assets, which we have given, so we can cross that off. Other assets, and just so you know, I pre-typed all of this because this was not going to be like an hour-long video. I hope it's not an hour long. So other assets, we have that from above given. So now we have enough to determine current assets, and current assets is basically going to be total assets is going to be the current assets plus these two assets, right? So we can do it one by one, which I did it here. So then I just did equals current assets plus other fixed assets plus other assets, and then press enter, and then you get that response. So now the next thing that we have to do is get the current liabilities, and we get the current liabilities, right, from the payables. So then the liabilities is everything that we owe to someone, right? So our accounts payable, meaning the things that we owe out, is 67,000, right? Which is here, it's given. So let's cross that out since we move it here. Notes payable, 36K, we moved that, so let's cross it out. So now in order to find out the current liabilities, we just add the two. So let's do the auto sum way and highlight and select this down to the cell that we want to put it in, put our answer in, and then just click here. Nope. Okay. Yep. So then our current liabilities are going to be the accounts payable plus the notes payable. So then that's essentially what it's going to be. So now our long-term debt, we have it here, right? We have a long-term debt that we moved down. So let's cross out this. I need to be consistent. Long-term debt is 223,000. We moved that down. Common stock is 150,000, so we move that down. And then in order to find out the retained earnings, here's the big one, right? We have total assets, we have current liabilities, and we have long-term debt, and we also have common stock, right? So what we do is we take the total assets minus, and then you want to open parentheses, because basically what you're doing is you're taking your total assets and you're subtracting all of your liabilities. So in order to get Excel to do the liabilities first, the smart thing to do is to put to do total assets minus, and then open parentheses, your current liabilities plus long-term debt plus common stock, and then you get your answer. And the answer is $97,118. Okay, so then that's that. So now moving along to question 3.5. The question is working capital. Laurel Electronics reported the following information at its annual meeting. The company had cash and marketable securities worth $1,235,455, accounts payable worth $4,159,357, inventory of $7.1 million, accounts receivable of $3.4 million, short-term notes payable $1.1 million, and other current assets $121,455. What is the company's net working capital? So again, step number one is to identify the given, right? So like I said, I've already pre-typed all of this, but as I'm talking, let's disregard this area here. So we've already have the given that we pulled from the question above, and our objective is that we have to find out what the company's net working capital is. We have to remember, right, that net working capital, if you remember from the book, hopefully you've read the book, net working capital equals current assets minus current liabilities. Payable is everything that you owe out, and a receivable is everything that you are owed. Okay? So now the second step here is that we take what's given, right? Cash and marketable securities, we can bring it down. Accounts, we have inventory also, right? So we can cross that off, we move it down. Accounts receivable, 3.4 million, we can take that out. And other current assets, right, is 121, right? So why didn't we include it all? Because these are not all assets, right? The only thing that are assets is everything that we have as that we own, right? So, and we also own the things which we are owed. Okay, I hope that made sense. So our total current assets, when you add up all of these, equals 11,966,630. Now we can work on the liabilities. Our accounts payable, we have here accounts payable, okay, and then we also move short-term notes payable down here. So our total liabilities is basically just adding these two, and that's it. And our total liabilities comes out to 5.3 million. So in order to identify the net working capital, the only thing that you do, remember here, current assets minus current liabilities. So then you take the current assets, right? Let's delete this. You take equals current assets minus total current liabilities, and then you get your answer, which is 6,655,610. All right. So then that's 3.5. Now moving on to 3.7. Let me zoom in here. All right. The Oakland Mills Company has disclosed the following financial information on its annual reports for the period ending March 31st, 2014. Sales of 1.5 million, 1.45 million, cost of goods sold of 812,500, depreciation expense of 175,000, interest expense of 89,000. Assume that the firm has an average tax rate of 35%. What is the company's net income? Set up an income statement to answer the question. So step one, again, as always, identify the given. We take all of the information that we know, all the facts from what's in the problem above, and the bottom line is that we need to identify what the company's net income is, right? So now the second step is to set up an income statement. So we know that revenues are 1.4, right? And that's from up here given. And the cost of goods sold is 812,000, right? So then our EBITDA, which is basically earning before interest, taxes, depreciation, and amortization, is 637K, right? So now we have to remove the depreciation, which is our depreciation expense is 175,000 as listed above. And when we remove this from 637,000, we get our earnings before interest and taxes, right? So it's not EBITDA anymore, it's just EBIT because we took out the depreciation, okay? Next, when we have EBIT, the earnings before interest and taxes, we want to remove the interest expense. And the interest expenses is here from the given, 89,000. And the earnings, and then it no longer, it is no longer EBIT, but just EBT, which is earnings before taxes, because you took away the interest, so it's no longer EBIT, just EBT. And we know that taxes are 35%, right? So knowing that the taxes are 35%, all we do is we take the earnings before taxes and then we multiply it by 35%. It's very important that when you're working with Excel, you put the percent, okay? You can't just put 35. It doesn't work that way. You have to put the percentage in order for Excel to calculate it right. So when you do the EBIT, the EBT, rather, 372K times the 35%, you get 130,000, $523.75 as the taxes. And then the net income is simply the earnings before taxes minus the taxes. And when you do that, you can do it this way. You can just put equals earning before taxes minus the taxes, and then you'll get your answer, which is 242,401.25. Sorry about that pause. I'm looking at other material as I go along. All right. So the next question up is 3.9. All right. So now this is the whole thing, but I broke it down by steps so that we can understand it. So you've already seen the answer. So cash flows during 2014, Towson Recording Company increased its investment in marketable securities by 36,000, funded fixed asset acquisition by 109K, and had marketable securities of 14K mature. What was the net cash used in investing activities? So the first step that we do is we identify the given, right? Investment in marketable securities is 36,845. Now, one thing that you should know is that when I typed this in, I typed it in as a negative 36,845 and I made it red. Why? Because in investment, we consider it a positive thing, right? But the bottom line is that investments are money out. And since it's a money out thing, I made it a negative, okay? Then investment in fixed assets, right? Cars, plant, whatever. This is also money out. So then I listed it here as a negative 109,455. and the maturing of marketable securities is $14,215. So now that we've identified the given, the second step is to determine the total investment in the marketable securities, right? So the investment in the marketable securities is this, 36,845. So let's X that. Let's cross it out. Investment in fixed assets, 109,455. Let's X that. So then the total investment is basically adding these two. So you know that when you add two negatives, you get a negative, right? So 109 plus 36K equals 146,300. So then that was the total investment. So now the third step is to determine the net cash used in the investing activities. So to determine the net cash that was used in the investing activities, what you do is you take the amount of the total investment, which we know was 148,300 out, and then in the maturing of marketable securities, we got a little bit back, right? So then when we add them both, because we're adding a positive 14,000 to this negative 146, we determine that the net cash that was used in the investment activity was 132,805. Okay, and that's 3.9. And if you rework this a different way and you still come up with the same answer and you don't use the negative scheme that I have going on here, that's totally fine. Just as long as you understand the concept of money in, money out. Okay, so then that was 3.9, and next up is 3.13. This one is a short one, and this one is about cash flow. So the Hillman Corporation reported current assets of 3.4 million, and I'm gonna say that so that shorten these figures, so this isn't a super long video. For the year ending December 31st, and current assets of 3.1 million for the year ending December 31st, 2013. Current liabilities for the firm are 2.8 million and 2.7 million at the end of 2014 and 2013 respectively. Compute the cash flow invested in net working capital at Hillman Corp during 2014. So now here we identify the given, right? Current assets for 2014 was 3.4 million, right? Total current assets 3.4 million. We're done here. Total current liabilities was 2.8. 2.8. So be careful. You have to read the question carefully. It's not 3.4 and then 3.1 in liabilities. These are the liabilities here in the next sentence. So you have to be very careful and consider these questions kind of like a big knot. And your objective in doing these step ones is to untangle all of this so you understand what the question is asking. So now we know that. So then we take current assets, right? 3.1, we know that from the problem here, $3.1 million, and then the current liability is $2.7 million, which was the latter half of the second sentence, right? Compute the cash flow invested in net working capital at Hillman Corporation. So the net working capital, in order to identify that first, you need to know what the net income was. So in order to identify the net income, all you do is you take your assets for the year and then you subtract the liabilities. So when you do that for 2014, you get net income, right? Let's just put NI here of 627,830, all right? And then when you do it for 2013, you have 3.1 million, 2.7 million, subtract them both, and then you get net income of 343,715. So then the cash flow invested is the difference between the two. You take the 627,000 minus the 343,000 and you get your answer, which is $284,115. And that is the answer for question 3.13. And now we move on to question 3.17, which is taxes. And now here is where your accounting courses are going to come a little bit in handy, right? So now, the Mann's property management company announced that in the year ended June 30th, its earnings before taxes amounted to 1,478,936. Calculate its taxes using Exhibit 3.8 in the text. please use Exhibit 3.6 in the text, okay? So now what's given here is the earnings before interest and taxes, right? Which is 1.4 million. And then this is the table that's presented to you, right? So now here, this is our work here. An example of how to solve this problem is on the bottom of page 74, so you may want to take a look at that. And one tip is that you have to look at this table and say, okay, which range are they not in, right? So let's look how much they made. $1.4 million. So what is it? Is it 50,000? No, they made more than that. They made more than 75, more than 100,000, more than 335, but less than $10 million, right? So we know that looking at this level here, the 10 million to 15 million doesn't apply. So then why don't we do this and just blank it out? You know why? Because we don't need to see that. It's extra stuff. So what we do here is in order to calculate the amount of taxes, this is what you do. And if you follow the bottom of the page 74, as you're looking at this, it will make sense to you. So now, this income level was basically copied over from here, from the table. So then this means that on the first $50,000, the tax rate is 15%. So then the amount of taxes owed on that first $50,000 of this whole amount was $7,500, right? But now, so now that's done. So let's put check. Okay. Then we move on to the next level. So basically, the next level is 75,000. So now you're not gonna get taxed on the first 50,000 again, right? You're only being taxed on the difference between what the level ended at and what the new level is. So basically, what you do in order to determine the amount of the taxes is you take the 75,000, which is the higher range of this here, and then you subtract the prior, right? The previous level where that ended at. So then in this case, it's the 50,000, and then for this particular level, the tax rate is 25%. Okay, and then when you do that, you get taxes of 6,250. So now we have to calculate the next level, right? So now that because the company made more than this, so to calculate the next threshold here, and let's put check. So to calculate the next threshold, now the company is being taxed on the 75,001st dollar that they've made up to 10,000. So then on this $25,000, they're going to be taxed 34, right? So what we do is we take the 100,000 minus 75 because we want to calculate what the taxes are going to be on the $25,000 that they've made above the previous level, and then you multiply that by 34%. And then when you do that, you get 8,500, right? So then let's put check. So now let's move on to the next level. From 100,000 to 335,000, they're going to be taxed 39%. So what we do is, again, we take the 335,000 minus 100,000 times the tax rate for that level, which is 39%. And make sure that you put the subtraction in parentheses first so that the problem can take the tax out of that amount and not calculate it in a sequence. And when you do that, you get 91,650 as the taxes. So let's put check. And now we're here at the final level, right? So now, in order to calculate the taxes for the final level, and then all of these were what we calculated in the problem, right? In order to determine this last level here, if you notice, they've only made $1.4 million. I say it like it's not a lot of money. It is, but they didn't make $10 million, right? So it would not be fair to charge this company taxes on $10 million. It just wouldn't be feasible. So they're only going to be taxed on the difference between this last level where it ended and their 1,478,000 $478,936, and that's it, right? So now we need to find the difference between the total amount that they made and the upper side of this threshold, which is why we do the 1.4 million minus this upper level here, 335, and then we multiply it by the threshold. So by the rate. Be careful not to multiply it by this one because it's going to be wrong. Okay, so you want to make sure to keep it consistent, and only use the rate that pertains to that particular level. So right now we're doing this level right here. So now again we do the income the total amount made, right? Because now we've understood that this is the tax level that this company is at, minus 335K times the rate, and that gives us 388,938 and 24 cents. So in order to calculate the total tax, all you do is just add them up. So you add up all of these. I use some here just to show you a different way of getting to it, but you can also go like that and then just click auto sum, and you'll still get the answer, right? 502,838 and 24 cents. It's a lot of taxes. All right, so that concludes 3.17. Now we move on to 3.19. Now, this one is probably the one that is going to be a little bit more on the challenging side. So if there are any other problems that are similar to this one, now you'll know how to do it. The problem reads, Mukhopadhyay Network Associates has a current ratio of 1.60, where the current ratio is defined as follows. The current ratio equals current assets divided by current liabilities. The firm's current assets are equal to $1.2 million, its accounts payable $419,000, and its notes payable $351,000. Its inventory is currently $721,000. The company plans to raise funds in the short term debt market and invest the entire amount in additional inventory. How much can notes payable increase without the current ratio falling below 1.50? So the first step again is identify the given. This is all the information that we've untangled from here. And what we need to do is find out how much note payable can increase without the current ratio falling below 1.50. And if you read the chapter, you'll understand what the formula is for the current ratio, which is the current assets over the current liabilities. All right. A tip that I can give you is that we're going to have to use algebra to figure this one out. It's not if you this is the easy way that I've determined how to do it. I couldn't figure out an easy way to do it in Excel, but if you want to try it, you're more than welcome to do it. Let X be the amount that's raised through the notes payable. All right. So now let's move on to the algebra here. So now we have to, step 2 is to set up a formula, an algebraic formula. So now we know that the new current liabilities, right? Because we put new because we put new current liabilities because it's gonna be our new one. 419, which is given here, plus 351K, which is payable, plus X. So we put plus X because this is the amount that we're going to be raising through the notes payable, and it's what we're going to be figuring out. Once we get X, we have the answer to our problem. The new current assets is going to be $1.2 million, which is here given, plus X. And remember, this X is the amount that's raised through notes payable. The current assets over current liability equals 1.5, right? And that's the level that we want to keep it at. And then we put 1.5 equals the 1.2 million plus X, which is this one right here, over 771,000 plus X. Why 771? Because we added 419K plus 351K. The third step is to move the 771 to the other side with the 1.5 with the ratio. So if we can kind of like ignore this part here and just keep it at 1.5 equals and then the rest of this. So when you move the 771,000 to the other side, we now have 1.5, which is brought down from here, right? Our threshold for the current ratio, times, and then in parentheses, $771,020 plus X equals 1,233,265 plus X. All right. The next step is that we have to continue solving for X. So then when you work it out, you get 1.1 million plus 1.5x. Why 1.1 million? Because, well, let me continue to explain here. So 1.1 million plus 1.5x equals 1.2 million plus x. So the reason why this is 1.1 is because 1.1 million is because we have to take the 1.5 using, again, algebra, not my favorite subject in the world, by the way, 1.5 million, and then multiply it by 771,000, and then that's where you get this. And then when you take the 1.5 and then you multiply it by the x, you get 1.5x. So now the fifth step is that you subtract x from both sides and move the dollar amounts to the other side. And when you do that, you get 1.5x minus x, okay, which equals $76,735. Okay, so now one tip that I can give you, and it came to mind when I was working on this problem, is that when you're subtracting you subtract the x from here and then it cancels out. When you're subtracting the x from here, it doesn't cancel out the x. It becomes net minus x because you have to remember that x is really 1x, all right? The sixth step is to subtract x from 1.5x, and when you do that, when you subtract 1x from here minus 1.5x, you end up with 0.5x, which equals 76,735. The seventh step is to divide both sides by 0.5. So this side, 0.5 divided by 0.5, 76,000 divided by 0.5, and then when you do that, you get $153,470. So the bottom line is that $153,470 is what the firm can add in inventory by raising money through notes payable without changing the ratio of current assets to current liabilities to more than 1.5. So this is the answer to your to the question. So now we move on to question 3.21, an easier problem, not really algebra anymore. Nimitz Rental Company provided the following information to its auditors. For the year ended March 31st, the company had revenues of $878K, general and admin expenses of $352K, depreciation expenses of $131K, leasing expenses of $108K, and interest expenses equal to $78,122. If the company's average tax rate is 34%, what is its net income after taxes? So the first step is to identify the given. We bring this down from the problem, and all we need to do here is just identify the company's net income after taxes. So the second step is to create an income statement and organize the above and solve for the answer. So we know that the revenues are given, so we cross this out. Oh, wrong type of crossing. And then we subtract general and administrative expenses, and as well as the lease expense. Okay, so we didn't subtract depreciation yet, although is an expense, or interest, because we want to know, it's good practice for you to know what the earnings before interest, taxes, depreciation, and amortization is. Okay, so then basically this is just revenue minus general and admin expenses minus the leasing expenses. So you get 417,551. Then we pull down the depreciation expense from up here, right? And then we get the earnings before interest and taxes, which is 200. It ends up being 286,000, and we get that by taking the earnings before interest, taxes, depreciation and amortization (EBITDA) minus the depreciation expense. All right, and then we want to subtract the interest expense so that we can narrow it down. We've narrowed it down from EBITDA to EBIT. Now we want to get it down to EBT, which is earnings before taxes. And we get, in order to we know that the interest expense is 78,122. So let's bring this down, right? And then we subtract it from the EBIT. And then when we subtract 78K from EBIT, we get 207,974 as the earnings before taxes. And we know that the tax rate is 34%, right? So the taxes that we're going to get charged are equal to the earnings before taxes times the tax rate. And so what we're going to have to owe in taxes is $70,711.16. So the net income after taxes is simply just going to be your earnings before taxes minus the taxes. It makes sense. When you pull the taxes out, then you find out what you're going to have to owe bottom line. Okay? So that's why I put here, this is just EBT minus the tax expense. And that's your answer for 3.21. And now we're going to move on to 3.23. Fraser Corporation has announced its net income for the year ended June 30th, 2014 was 1.3 million. The company had earnings before interest, taxes, and depreciation of 4.9 million, and its depreciation and amortization expense was equal to 1.1. The company's average tax rate is 34%. What is its interest expense? Okay, so now here for this one, we're gonna have to work backwards, right? There's some things that we know, which is given here, and we need to find out what the corporation's interest expense was. So the second step, let's go ahead and solve. We have earnings before interest, taxes, depreciation, and amortization, which is 4.9 million. And then we just simply subtract the depreciation and amortization expense, which is given. So let's go ahead and do this, right? And we're left with the earnings before interest and taxes. So now for the interest expense, we would need to know in order to calculate the earnings before taxes, we would need to know what the interest was so that we can take that out. But we don't know what that is, but we do know what the other parts are, right? We know that we can calculate the earnings before taxes. What we do to calculate the earnings before taxes is by taking the net income right here, which is, well, it was moved below, but it's basically that. So we take the net income, which is 1,353,412, and divided by, and in parentheses you put 1 minus the rate, and that's how you determine what the earnings before taxes are. In order to determine the tax expense, because we don't have it in the given, we need to take the earnings before taxes and then divide it by the rate, right? So then when we do that, the earnings before taxes and divided by the rate, we calculate how much is our tax expense. And our tax expense is 697,212.24. Net income is already given. So now that we've done this far, right, we took the given and we applied it to figure out a couple more things: earnings before interest and taxes, earnings before taxes, the tax expense. So now that we have the earnings before interest and taxes and the amount of the taxes, we can now find out how much the interest expense was. So all we need to do is just take the earnings before interest and taxes, which is from here, 3.8 million, bring it down, and the earnings before taxes, which is here, which we calculated. And once we do that, all we need to do to calculate the interest expense, and I should put here expense, is you just subtract the two. The earnings before interest and taxes, the earnings before taxes, and then you get your interest expense. So it is, I guess, mildly algebraic because you're trying to work backwards to get the interest expense, but that's essentially how you get it. So if a question asks you for interest expense, there's no way you can find out unless you calculate the earnings before interest and taxes and the earnings before taxes. You also have to find out their tax expense, and you need the rate. So there's a couple, you're playing with a couple different puzzle pieces here, but you will always be provided with everything that you need in order to solve the problem. So now let's move on to our second to last question, 3.25. And this one reads, Columbia Construction Company earned $451K during the year ended June 30th. After paying out $225 in dividends, the balance went into retained earnings. If the firm's total retained earnings were $846K, what were the retained earnings on its balance sheet on July 1st, 2013? Okay, so now be careful with the dates. All right, June 30th, 2014, July 1st, 2013. Okay, so now here we have to identify the given. We know the net income after taxes, we know the dividends paid, and we know the end retained earnings. We have that already. We just need to solve for the retained earnings July 1st, 2013. All right, so let's put it July 1st, 2013. Okay. The second step is to calculate the increase in retained earnings at June 30th. So the net income after taxes, we have it from up here. The dividends paid, we have it from up there. Let's cross that. So the retained earnings on June 30th is essentially just the net income after taxes minus the dividends that were paid. So now we know what the retained earnings on June 30th was. So now in order to calculate the retained earnings for July 31st, which is, by the way, the day after, but the year prior, not a super important fact, but just a little bit of verbiage there to keep in mind. Calculate the retained earnings for July 1st. So we know that the end retained earnings was 846, which was given from above, right? And the retained earnings on June 30th were 226,094 cents. And where do we get that from? We got it from right here because we calculated it. So in order to determine what the retained earnings were on July 1st, we have to take the end retained earnings, 846K, and the end retained earnings on June 30th and just subtract the two. And that's it. It was a pretty simple one. And now for the final one, which is another tax question. And hopefully with these two tax problems that we worked on, 327 and 3.17, you'll be able to answer any other ones that you're presented with, okay? And how to organize your thoughts. If you are not organized, you cannot be successful in these problems. You have to be organized, okay? And you have to pay attention to detail. So okay, that's where my rant ends. So now, here's the question. Mount Hebron Electrical Company's financial statements indicated that the company had earnings before interest and taxes of 718,323. The interest rate on its 850,000 debt was 8.95%. Calculate the taxes the company is likely to owe. What are the marginal and average tax rates for this company? All right, so for this exercise, for the purpose of time, we're just going to calculate the taxes because that's the longer part of this, and then you'll be able to answer the rest on your own. Again, the answer is in the back of the book, but I would like to see you get to the answers here, okay? So the first step is we identify the given as always. We have the earnings before interest and taxes, we have the debt outstanding, and we have the debt, right? Which is 8.95%. The bottom line, how much taxes is the company likely to owe? The second step is that we have to find out how much is taxable income. So we bring down the earnings before interest and taxes, which we got it from up here. And then the interest expense is basically what is this was just the outstanding debt times the debt percentage, right? So then we do equals debt outstanding times the amount of the debt. And then that gives us the interest expense. So now we need to find out what the taxable income is. And the taxable income is basically just the difference between these two. The earnings before interest and taxes, and then the interest expense. So then this is the taxable income right here. So then when we're looking at our tax table right over here, right, you remember that from problem 3.17? This is what we're going to go by. So let's color this blue because I guess it's different than all these other ones. But this is the amount that we have to determine what the taxes are on, right? So let me move this over. The third step is to use the tax schedule to figure out how much in taxes are owed. So you can definitely use question 3.17 as a benchmark. So just to show you, these were all calculated by me. And so now we know that they have 642,000 as taxable income, right? So let's look at where they end, right? So 642,000 is more than 50,000, right? It's more than 75,000, so we have to keep going. It's more than 100,000. It's more than 335,000, but it's not more than 10 million, right? But it is more than the bottom part, the bottom range of it, 335. So what happens? We should totally get rid of this part because it's going to confuse us and it's unnecessary for us to know all of this stuff. So let's go ahead and fill that, right? And then fill this. Okay, we don't even need to see that stuff. Okay, so now in order to calculate the taxes on each chunk of the income, we need to do what we did back in problem 3.17. So now for the first $50,000, the tax is just going to be 15%, right? So we do 50,000 times 15%, and that gives us $7,500. So now we do check, right? Excuse me. So now on the next income, on the next, I guess range, we can call it, just to simplify the discussion, we're going to be taxed on the next 25,000 that we made above this 50, right? So from the 50th, so from the 50,000 and first dollar to the 75,000th dollar, I guess, $75,000, we're going to get taxed 25%. So in order to do that, we do 75,000, right, minus the 50,000, which is the same thing as getting it from here because this is just copied over, times the tax for that range, which is 25%. And when we do that, we get 6,250, right? So now we got 2 levels done. So for the next range, right, is from $75,001 through 100,000. That's going to be 34% tax, right? So to calculate it, we do 100,000 minus 75,000, which is 25,000 also, times the rate for that range, and that's 34,000. So that's 8,500, and that's check, right? We're done with that. The next range is from $100,001 through 335,000, and that is going to be taxed at 39%, right? So in order to calculate that, we take the 335 minus the the upper range of the previous range, 100,000, which again you can just take it from here. I just did it here to show you a different explanation for it. Times the tax for that range, which is 39%, and you get 91,650. So now we did that range. Okay. Now, remember that they didn't make more than $10 million. So the trick here is to make sure that this eighth dollar right here is the last dollar that you're going to tax on, right? So to do that, we take this amount, 642,248 minus the top cap of the previous range, which was 335, which you can also just get from here, times the tax rate for that particular range right here, 34%. And when you do that, you get $464.32. So in order to calculate the total taxes, guess what you do? You just add them all together. And then when you do that, you get the total taxes of $218,364.32. All right, and I leave it to you all to determine what the marginal and average tax rates are for the company. That's something that's covered already in the text. And this concludes my tutorial of some questions for Chapter 3. Again, we covered 11 questions from the homework. You're expected to do questions 3.1 to 3.27. For those that warrant usage of Excel, I encourage you to use Excel. For the next unit, you will be required to use Excel from that point forward because there won't be like open essay questions or anything like that. But as always, if you have any questions, comments, or concerns, please feel free to reach out at any time, or you may send me a text, and I'll respond back at my earliest convenience. Again, this is Dr. Carl Letamendi, and this was a recap of the Chapter 3 homework of FIN3400. Thanks for watching.